Welcome to the Money Show. I'm Rob. Today we're going to talk about target date funds. Who are they good for? Should you invest in them? Are they really a good idea? How much money do you need to invest in them? That's what we're going to talk about today. Should you really invest in them? So let's get started. Target date funds are basically nothing but a fund of funds. What does that mean? Basically means that with a single fund, you are investing in multiple funds and you are very well diversified, as we're going to see in a moment. So what are the features of a target date fund? What are they designed for? Well, basically they are designed based on when you're going to retire. So say for example that currently you're 50 years old. So you're planning to retire at say age 65, so that's 15 years from now, and you want to invest your money in a investment. And so the target date fund that you really want to invest in is the target date fund 2037, as we can see here. So let's say that you're not 50, let's say that you're 40 and you don't want to retire at age 65, you want to retire at age 70. Well, in that case then you want to invest in the target date fund 2052. As we're going to see in a moment, we have a lot of flexibility with these target date funds. So, but in this case, we're going to stick with a 50-year-old who wants to retire at age 65. So you need to look for a fund that basically a retirement date fund that ends on 2037, or a 2037 retirement date fund. So that's what we're going to look at. All right, so what else do we need to know about retirement date funds? Who can benefit from them? Well, people who have less than $20,000. If you have 1,000, 2,000, all the way up to 20,000, you're better off buying and investing in a target date fund. As we're going to see in a moment, they have their pros and cons, but this is basically a fund that you want to invest in if you have less than $20,000. All right. The other thing is people who want to set it and forget it. You just want to buy it once and be done with it. You don't want to do any research. You don't want to be spending any time researching, well, should I be investing in this fund? Should I be looking at YouTube videos to try to find out which fund to invest in right now? No, you just want to set it and forget it. No research whatsoever. And these are also good for people who want to spend time, or who don't want to spend time, rather, rebalancing their portfolios. What does that mean, rebalancing? Well, sometimes you do it every quarter, sometimes you can do it every 6 months, every year. Say, for example, that you have $20,000 invested, and every year you say to yourself, well, should I be investing more in stocks than bonds? My stocks have grown in value, whereas my bonds have not. Then I should definitely do a rebalancing. I should sell some of my stocks and I should buy more bonds so that I'm not overweight on stocks. That's basically what rebalancing means. And with target date funds, you don't do any of that. So that's why they are very practical. Okay, so what are some of the pros and cons of target date funds? On the pro side, we have that no financial advisor is required. You don't need to see a financial advisor to invest in them. Very easily done. Also, very easy to invest and manage. Once you select the fund that you want to invest in, you can invest in it either monthly, quarterly, yearly. You decide, and it's very easily to manage. With this single fund, you're going to have complete diversification, because remember, you're investing in one fund, but this fund invests in many other funds, so you have complete diversification. Also, it's very inexpensive way to invest. A lot of these charge you very low fees so that you can invest in these funds, or we're going to see in a moment here. Low investment minimums. basically a lot of these you don't have to have $5,000, $10,000, $15,000 to invest in them. You can start out with as little as $50. So you can invest in these without having to have a lot of money in them. Okay, and the last pro here that we have is automatic yearly rebalancing. It will do the rebalancing for you. You just sit back and do nothing. Remember, this is a set it and forget it type of investment. On the con side, we do have a few cons here, and the first one here is that you're unable to make investment adjustments. Let's say that this year bonds are going down, they're not very good, and you say, hey, wait a minute, I don't want to be in bonds this year. Well, guess what? Tough luck. You get what you get. You cannot say to anybody, hey, I don't want to invest in bonds this year. Or the reverse, I don't want to invest in stocks. They're too risky for me this year, so I want to be out of them and put my money into bonds. You cannot do that. You get what you get. Another con is the glide path. That is set and you cannot change it. What is the glide path? Basically, the glide path is that when you start investing in this target date funds, it starts investing very aggressively into stocks and very little into bonds. As you approach the target date, say for example, you select the 2035 target date fund. As you approach 2035, more of your money is going to be invested in bonds than is going to be invested in stocks. So it's very, and maybe you don't want to be basically all in bonds. You want to have maybe 70% invested in stocks and only 30% in bonds. Again, this depends on your situation, because the company is basically trying to tell you, hey, you're about to retire, you shouldn't be invested in stocks because those are more risky, so you should be investing more in bonds. So that glide path takes you automatically towards more investing in bonds and less invested in stocks, which could be a good thing, but it could also be a bad thing for your own situation. All right, so the first target retirement date fund that we're going to take a look at, it's the VTTHX, Target Retirement 2035. So that means that you're going to be retiring in the year 2035, as the name states it there. So let's dissect this target retirement fund, and here we can see this is what you want to pay attention to: the expense ratio. Notice that it says these are the costs that this fund is going to charge you to invest your money. The lowest the expense ratio, the better off you are. The higher the expense ratio, you're going to be paying more for this particular investment. So this is very good because look, it's 0.08%. So this is great, very inexpensive. So let's take a look at how your money is invested. Year one, if you invest in this target date fund, here's where your money is going to go. 54% of it, it's going to be in US stocks, 36% of it in international stocks, only 7% in US bonds, and 3% in international bonds. So basically 10% of it is going to be invested in bonds and 90% of it is going to be invested in stocks. As you move on the different years here, notice that here's 30 years before you retired, 25 years before you retired, and here is the actual retirement date here. Actually, this is Retirement 2020 Fund. So let's look at the 2035 right here. There we go. So in 15 years, when you retire, 43% of it is going to be invested in stocks, 29% of it also in international stocks. But look at here, 20% of your money is going to be invested in US bonds and 9% is going to be invested in international bonds. So as you can see, you're investing more and more of your money in bonds than stocks. Obviously, you still have 43% of your money in US stocks and 29% of it in international stocks, but the allocation is gearing more towards investing in bonds. So this is basically what it's called, the glide path here, that as you get closer to your retirement date, more of your money it's going towards bonds. All right, so let's take a look at here. Did we take a look at how much do we need to invest? Yes. Okay, so minimum to invest in here, look, NA, that means you can start investing with as little as $50 on this one here and then work your way up. All right, if you have 5,000, that's good. If you have 10,000, that's good, but you don't need to have all of that money invested from the get-go. There's no minimum no minimum amount requirement for this one. So you can invest any amount that you have, any amount of money. Okay, so let's look at the portfolio. Portfolio is, what does this target retirement fund invest in? Well, here's what we said. Remember that we said this is a fund of funds. So within this one single target retirement fund, you're investing in 1, 2, 3, 4 different funds here. Actually 5. Yes, 5 different funds. So you're investing in the total stock market index fund, the total international stock market index fund, the total bond, this is US bond market, and the total international bond market. And finally, you also have short-term inflation protected securities, or TIPS. So as you can see, you are well diversified. Not only are you investing in stocks in the US and international, you're also investing in the bond market in the US and international bond market. So you are very well diversified. And as far as the yield and distribution, well, here is where you can see, when do you get any type of dividend income from investing in this fund? Do you get it every month? Do you get it every quarter? When do you get it? Well, as you can see, this fund pays yearly. So don't be expecting any income every month, because you're not going to get it. When you invest in it, let's say that you start investing in January, you're not going to see any type of dividend income until the end of that year, which is December 30th. So don't expect any income. If you're trying to get some income for your living expenses on a monthly basis, this is not the vehicle for you to invest in, because you're only going to see income at the end of the year. All right, so this is the Vanguard Target Retirement 2035. Let's take a look at what Fidelity has to offer. Fidelity doesn't call their funds target date funds. They call them freedom funds. So the Fidelity Freedom Index 2035, basically the allocation is pretty much identical to what the Vanguard fund has to offer. U.S. equities, 46%, non-U.S. equities, this is international, 30%, bonds, 24%, and they have less than 1% in short-term debt and other assets. This is probably cash. In any case, it's pretty much identical to what Vanguard has to offer, but this one is charging us 0.12%. So Vanguard charges us 0.08, this 0.08, this one charges us 0.12. And there is no minimum, as you can see here. So you can start investing in this fund with as little as $25 as well. Let's take a look at what Schwab has to offer. They offer the Schwab Target 2035 Fund. They're charging us 0.56%, which is a lot higher than Vanguard or Fidelity. And let's take a look at to see if there are any minimum investments. Here, they're telling us that there are no minimum investments, so you can start with as little as $25 and work your way from there. So you can invest 100, 200 in every week, every quarter, every month. It's up to you. And here, I wanted to show you the glide path. See, this is the glide path, and this is what I was talking about. They illustrate it perfectly. When you start out investing in a target date fund, notice that 97% of the money it's being invested in equities. Equities is the same thing as stocks. So 97% of your money is going into stocks, and only 3% is going into bonds. As this is the glide path, as you start getting closer to the 2035 period, when the target date, basically you can call it as matures, notice that the glide path now is investing a lot more of your money into bonds. Now we no longer are investing here 97% in stocks. Now we're down to 44% in stocks and 56% in bonds. And if you stay invested in this longer in this fund, look, you can go up to 72% in bonds and only 28% in stocks. Now that could be good for you, but it also could be bad. Again, it depends on your situation. But this is the way it is. This is called the glide path, that it starts out very aggressively investing in stocks, and then by the end, you start out investing more of your dollars into bonds and not in stocks. Let's take a look at the actual portfolio for the Schwab target date fund. Okay, so the index 500, it's investing 19% into the 500 index. International, another 12% in the international. U.S. aggregate bond, so they throw bonds in here as well, pretty much what Vanguard and Fidelity are doing. Then you have the international core equity, another 8%. This is a third-party stock fund here from Dodge and Cox. That's 6%. And real estate, they also are investing 5% of your money into real estate. Large cap growth, they also have small cap here at 4%. So as you can see, this one's a little more diversified, but not by much. So does it justify the 0.56% that they're charging you in expense ratio? Well, we're going to see. Let's take a look at the three funds under Fund Analyzer, and let's see which one is more cost effective. Again, these three funds, the Vanguard, the Fidelity, and the Schwab target date funds, are investing in pretty much the same investments, same investment vehicles. So we need to pay as little as possible so that we keep more of our money. As we can see here under Fund Analyzer, after year 10, on year 10 here, Vanguard, we would only pay $103 in fund fees. This is our cost after 10 years. For Fidelity, we would be paying $154 to invest in that Fidelity Freedom Index 2035 fund. And for Schwab, we would be paying a staggering $700 to be investing in that fund. So as you can tell, the more cost-effective vehicle to invest would be the Vanguard Target Retirement 2035 at $103. Next in line would be the Fidelity Freedom Fund at $154. We just saw that the lower the expense ratio, our costs are lower to invest in those funds. So Vanguard obviously came up on top because they're charging us a lower expense ratio than, say, a Schwab at 0.56. But now let's take a look at how much money we would actually have at year 10. And here's basically what we're estimating. We're basically saying that we're investing $10,000. and we would get a 5% rate of return yearly, and our investment horizon is 10 years. So $10,000 at 5% for 10 years. Which fund would we end up with more money at the end of year 10? So here is the picture. With Vanguard, we would end up with 16,159. With Fidelity, we would end up with $16,095. And with Schwab, which charges us the highest expense ratio, we would have less. We would have $15,402 at the end of year 10. And here are the numbers. So as you can clearly see, the lower the expense ratio, the better off you are, because you're going to be paying less in costs. So to wrap it up, why should you invest in target date funds? Reason number one is you don't have a lot of money to invest. You have 500, 1,000, 200, anything less than 20,000 should be invested in target date funds. They offer a lot of diversification with a single fund, because remember, this one single fund is investing in multiple funds. So you have a lot of diversification. Reason number two, it's being professionally managed. You don't need to talk to a financial planner to do this. You can do this on your own. Just select either a Fidelity, a Charles Schwab, or a Vanguard fund that you're interested in, and then you can invest in it. No need to talk to a professional money manager for this, and it's being managed for you professionally. Reason number three, automatic rebalancing. You don't have to do a thing. This is a set it and forget it type of investing. And number four, it's very low cost investing. Remember, just keep track of the expense ratio, and the lower the expense ratio, the better off you're going to be. If you've enjoyed this video, please don't forget to give it a thumbs up, and don't forget to subscribe. If you have any questions, comments, please send them to me. Leave them in the comments section and I'll get back to you. If you like target date funds, if you don't like target date funds, what's your experience being with target date funds? Leave them in the comments section, and I'll see you on the next one.